A good evening, everyone. I'm Yikai from Supermart. Welcome to this evening webinar, Beating Fixed Deposit and Saving Rates, question and answer with LGI Fund Manager. So markets around the world are taking a beating as they face pressure from various factors, from the ongoing pandemic to the Russian-Ukraine war. Rising inflation rates around the world are not helping, and central banks are becoming more hawkish. The Fed itself has raised interest rates 6 times this year, and with more to come. So all these are causing investors to withdraw from the markets. However, putting your spare cash in a savings account seems unappealing, especially when savings accounts interest rates are not in sync with the hike in interest rate by central banks. So what other alternatives do investors like you and I have? So with me, I have Darren Liu, Investment Adviser, FSMOne Singapore, who will share with us alternatives to saving accounts. These other cash parking facilities generate returns higher than the typical savings account, helping investors to fight off the inflation monster. And it is also my privilege to introduce Jessica Sun, Fund Manager from Lion Global Investors, or LGI in short. So Jessica is a certified CFA and also the head of the RMB Fixed Income Strategy team at LGI. And she has over 22 years of fund management experience. Jessica is here to share with us her perspective as a fund manager on how they manage cash funds in this turbulent time. In addition, over a virtual fireside chat, she and Darren will also delve into strategies that LGI is adopting for major currencies, especially RMB. If you have any questions along the way, feel free to put them into the Q&A box, and our speakers will get to them over the course of this evening. Without further ado, let me pass over to Darren to start the webinar going. Darren, please.
Hi, thanks, Yikai, for the introduction. I'm Darren from the advisory team, and once again, thank you for attending the webinar today. So as you know, as Yikai mentioned, that the market continues to be very volatile, arising from a number of factors such as inflation and the Russian-Ukraine war and rate hikes. So for the conservative investors who prefers to be keeping more cash while waiting for opportunities, they may ask, where can they park their cash? So with the rising interest rates, the yields of the government securities such as the T-bills, the Singapore government securities, SGS for short, the short duration bond funds and the money market funds, and even fixed deposit and bank savings rates have went up. So at FSMOne, we have our own cash solutions that investors may choose to park their monies with low risk without any lock-in period, and it's also a good place for our clients to start. If you are new to FSMOne, then you will need to know that the most trades on our platform has to be pre-funded. So which means that you have to deposit your monies into your FSM account first before making the investment. And we'll give you good reasons to do that as well, because you pay a good interest and for parking the funds with us. So if you are not too sure what to buy yet, you can just transfer your funds into one of the cash solutions and start earning interest first. So there are 2 cash solutions that you can choose from, which I will cover today. So first is obviously our cash management portfolio, which is our Auto-Sweep. So the current yield is about 2.15% per annum. And if you're wondering how we achieve this yield, we actually buy into short duration bond, the money market and the cash funds. So the Auto-Sweep is also seamlessly integrated into our payment methods, which means that you can make use of the monies in the account to directly pay for your investments. There is also absolutely no need to manually liquidate or to redeem your holdings to make the payments. So you can use the Auto-Sweep as a payment method for unit trusts, bonds, stocks and ETFs, and also our managed portfolios. So second is our default option is the multi-currency cash account. So unlike the Auto-Sweep, which is only available in 2 currencies for now, the multi-currency cash account gives you access to 10 currencies, including the popular ones like the US dollar, the Hong Kong dollar, and the Malaysian ringgit. The exchange rates that you see on the FSMOne are also the real time, and also you can make currency conversions when you happen to see attractive rates, like what the Malaysian ringgit is now. I mean, there's quite a bit of attractive rate now. We have also raised the interest rates for Sing dollar, the US dollar, and the Hong Kong dollar this year. So since the 1st of November, we have revised the rate upwards for Sing dollar to 0.6% per annum, for US dollar to 1% per annum, and also the Hong Kong dollar to 0.4% per annum. Okay, now I'll touch on the different Singapore government securities where you can park your spare cash to get good yields. So first is the Singapore government securities bonds, so which is the SGS bonds, which are fully backed by the Singapore government. The bond has the strongest credit rating of a AAA by major credit agencies. The SGS bonds pays a fixed coupon with maturities between 2 and 50 years. The latest yields on some of the SGS bonds are shown on the right. So next are the Treasury bills, or the T-bills for short. So they are the short-term Singapore government securities. So the T-bills are available in short tenors of 6 months and 1 year. So unlike the SGS bonds, the T-bills do not have interest payments, but they are issued at a discount to its face value. So upon maturity, the T-bills will be redeemed at its face value of 100. So the yields of the latest issues are shown on the right. You can see that some of them are hitting 4%. So if you're interested to get the new issues, here are the remaining dates for the new issues this year. So there are 3 more new issues for the 6 months T-bills for this year, but there are no more new issues for the 1 year T-bills. So you can refer to the MAS website for more details. So lastly, we have the Singapore savings bonds. So the Singapore savings bonds, or SSBs for short, are the special type of Singapore government securities. So it has a tenor of up to 10 years and it is issued monthly. So one unique feature of the SSB is that it gives investors increasing returns the longer you hold the SSB. So the yields of the latest issues are shown on the right. Okay, so for the more advanced and savvy investors who prefer to have a more hands-on approach, you can consider building your own cash solution from a wide selection of funds available on our platform. So you can construct your own cash management portfolio to have your desired risk profile from conservative all the way to aggressive based on the underlying funds and the composition. So the table shows some examples of the funds that you can mix and match for your own cash management portfolio. So do note that the yields include the fund level fees, but excludes the platform fee. And that the yields are not guaranteed and subject to the fund manager's discretion, and all unit trusts are not capital guaranteed. And for more details, you can check out our DIY cash management article by our research team on our website. So this slide shows the comparison of the different instruments which I've covered earlier, as well as some of the fixed deposit and savings accounts products in the market currently. So as you can see, there are different products have the pros and cons. Some products do allow flexibility, while some may need a larger investment amount in order to get a target yield. So some require some multiple conditions to be met to achieve the target yield. So, and also recently there are a lot of demand for T-bills due to the attractive yields, with some of them hitting 4%, and they're better than the FD and savings account rates. So next, we are excited to have recently launched the Auto-Sweep account for the CNH. So if you are unfamiliar with the renminbi, you'll be interesting to know that there are 2 types of renminbi. So renminbi that's circulated within China, referred to as CNY, and renminbi that's circulated outside of China, which is the CNH. So similar to the SGD Auto-Sweep, we actually buy into the money market and the cash funds. So the Auto-Sweep is also seamlessly integrated into our platform methods to pay for our investments such as unit trusts, bonds, and stocks and ETF. Okay, so next, we are excited to have Jessica Soon, fund manager from Lion Global Investors, to share a perspective as a fund manager on how they manage their cash funds in these turbulent times. She is a fund manager managing the Lion Global Enhanced Liquidity SGD Fund, as well as a sub-fund manager for the iFast Lion CNH Enhanced Liquidity Fund, which is the underlying fund for the CNH Auto-Sweep. So yeah, so let's welcome Jessica. So hi, Jessica. Sorry. Yeah, hi, Jessica.
Good evening, Darren. Hi.
Yeah. So glad to have you with us today. So I'm sure that the audience will be curious to know how does the fund manager manages the investments and stuff. So maybe we can start by understanding like how does LGI manage the liquidity strategies?
Right. Okay. So LGI has quite a number of liquidity strategies. So usually, what we have to do is that we have to ensure the portfolio stays liquid, while still remaining invested in order to achieve the highest possible returns. So in terms of liquidity, we actually approach it from all fronts. Firstly, we need to have access to as many liquid instruments as possible. So bills, as you mentioned earlier on, bills, T-bills, MAS bills. So like MAS bills is actually not available to individual investors, but available to institutional investors. And then fixed Ds as well. So fixed Ds are pretty much different for institutions versus fixed Ds that's available to the retail investors. So we are able to get various tenors and even up to overnight. And then government bonds as well. So besides getting the instruments, we also have to make sure that our processes are effective and tight from all fronts. And so this include getting timely and accurate reports, having our transactions being settled on a timely basis. And that calls for very close relationships with our counterparties as well as the custodians. So basically it's to manage all the portfolio instruments, investment instruments, as well as the transactions and admin matters on all fronts. So we leverage on all the different departments within LGI.
I see. Okay. Yeah. Okay.
Yeah, and if I just to add, so for investments, we also do have we do leverage on our strong execution capabilities as well. As you know, trading in bonds is not the same as like buying a stock on the exchange. So buying the stock on the exchange it's always there, and the price is also visible. So basically, the investor just need to decide how much you want to buy and at what price you want to enter and exit. But to trade in bonds is pretty much more opaque. It's not so transparent, and the bond offers are also finite as well. So an issuer may come to the market and just tap the market by issuing like 500 million. So the total outstanding amount is just 500 million. So sometimes it's tightly held within the hands of certain investors. So the bond offers may not always be there. So we do have a strong relationship with our bond counterparties so that we are shown offers first as and when they are made available. And we do also have access to all markets. So we do consider all markets and conduct our own relative value analysis to decide which market to go into.
Okay. Well, that's interesting. So how does this liquidity strategies different from the typical fixed income strategies that for example, those kind of like long-dated bonds and stuff?
Mm-hmm. So of course, for the typical fixed income strategies, most of the time the portfolio's objective is to outperform the benchmark. And so in order to do that, it needs to have somewhat more concentrated bets. And there may also be a need to trade more often. Whereas in the case of a liquidity strategy, the considerations are different. We need to ensure the portfolio stays liquid. So when doing that, we may pay more attention to having more diversification. And we will also be holding bonds to maturity most of the time. And so that calls for a more conservative approach when it comes to purchases and trades. And we also do tend to have a bit more of a laddering strategy so that we can have bonds maturing at different periods of time. So you don't have like very concentrated bond maturities within a certain time frame.
I see. Yep, I understand that you manage both funds for the Sing dollar and also the CNH denominated funds. So do you see any like similarities or differences between the SGD bonds and also the CNH bonds?
So unlike the US dollar bond market, which is so huge and more deep and more liquid, and has a broader universe of issuers and investors, the CNH bond market and the Sing dollar bond markets are much smaller. So in terms of liquidity, it is of course less liquid than the US market, and so that translates to a wider bid-ask spread as well. And given that it is a smaller market, in terms of the representation of the issuers, it is also more limited.
Yes.
So both are smaller and less developed markets for now. Then for the CNH market, the authorities, the PBOC, they try to develop the market. So it does also carry out auctions of bills and CGBs, China government bonds, as well. But that's also less frequent as compared to the Sing dollar bills issuances as well. In terms of the auction of the China government bonds within the CNH market, it is also less frequent. So I would say also the other difference is that in terms of the Sing dollar market, it tends to have a more captive investor base. So usually there's not enough issuance. So we end up with scarcity of bonds, which is unique to the Sing dollar market. And in fact, it is a very favorable factor for the Sing dollar market as well. And it's also coupled by the fact that the Sing dollar is an appreciating currency. Yeah. Whereas when we talk about the CNH, there's less of a captive investor base. Basically for the CNH, it's free entry and free exit for investors. So it can be subject to a greater volatility at times. Yeah. But in terms of the currency, one similar feature is that actually both are basket currencies. So both the Sing dollar and the CNH are managed by the relevant authorities as a basket of currencies comprising their trade-weighted partners.
Okay. Yeah. So having said that, so what's the outlook for the CNH bonds, and also how are the CNH bonds able to post higher yields than the SGD bonds?
Right. So of course, at the moment, DM markets, so basically US dollar markets and Sing dollar markets are having higher interest rates than renminbi interest rates. So this is a result of the divergent monetary policies and the differences in the macroeconomic environments. So as we all know, the world outside China is grappling with high inflation, and therefore we are all having high interest rates. But as we can all see, everything has a cycle, and so we are almost at the peak of the inflation cycle as well. Whereas in the case of China, it is in the opposite of the cycle. So in the last 1 to 2 years, it's basically been dealing with the economic downturns and a lot of headwinds due to the zero COVID policy as well as the property downturns. So the country actually did not have much inflation. But given that over the recent few days, we are seeing a turn and a change. So with the property the relaxation towards property as well as some relaxation towards COVID, Slowly we're going to see the return of more consumption in your industrial activity, manufacturing activity, construction activity will also start to have some rebounds. So at the moment, we are still coming at a very low interest rate environment within China. So given that we're at a low starting point, the medium term, the room for rates to decline in the medium term can be rather limited. So in terms of the CNH bond market, it does take direction from onshore. So given that onshore yields are low at the moment, we may be looking for some opportunities for yields to rise in the medium term. And where the CNH market is concerned, there is a yield gap between offshore and onshore. So we do sit on a positive yield advantage right now versus onshore. So that offers some benefits. But of course, in the longer term, China as an economy is structurally slowing down. So it's moving away from a high growth phase. So in the longer term, interest rates are still likely to stay low.
Okay, I'm sure a lot of bond investors are among the audience, and they'll be curious on what factors do you look at when you evaluate a bond for your investment?
Right. So actually, we do approach it from many fronts. So in terms of credit assessment, we would approach it from both the top down as well as the bottom up analysis. So I think it's quite a long topic to cover in this forum. But basically we would consider the industry factors, the macro factors, as well as the company specific factors. So we do conduct our own company specific credit assessment and look at their gearing, their cash flows, as well as the capital structure. So having done that assessment on the company in general, we would then move on to the yield and the spreads that's being offered by the bond. And so that's where we would look at the relative value analysis. And of course, we look at the overall environment as well. So in the current environment, yields are high, spread kind of become secondary. It's like if you look at a bond that's yielding 4% versus a bond that's yielding 4.2%. It may not make so much of a difference versus when interest rates are low and you're looking at a bond yielding 2% versus 2.2%, there that 20 basis point does become very significant when interest rates are low. Then of course we would also consider the overall macro environment, interest rate environment, and fund flows. So fund flows are really the factor that can affect how the bonds are trading in the market. So basically quite a comprehensive assessment we need to take.
I see. So having said that, what are the risks for bonds and how do you manage these risks for bond investments?
So generally, the anyone taking a finance module or a CFA course would know that the basic that we need to look out for: interest rate risk, default risk. But of course, in a downturn, we would be also looking more at downgrade risk as well. So downgrade risk would be particularly meaningful and important if it's if the name is going to be downgraded to a different rating category. So For example, it's being downgraded from A flat to A minus. That may not be as significant as if it's downgraded from A minus to triple B plus, or from a triple B minus to a non-investment grade rating category. Because, for example, if it gets downgraded from triple B minus to non-investment grade, it may get out of an investment grade index. So these are the considerations that we need to make. Of course, this year, default risk is quite a major consideration as well, especially for a lot of names within the Chinese real estate sector space. But in addition to that, there's probably other factors that we have to consider as well, depending on the environment. So, for example, call risk, whether a certain bond will be called or not in the current interest rate environment. For example, we'll look at what happens if the bond is not called. And then we'll also make an assessment from the issuer's point of view. Is it more economical for them to call or not to call? And we do also have to look into the legal docs of the bond to look up terms and conditions, because most of the time they may be similar, but sometimes there may be certain specific terms and conditions. So what happens if the bond is not called, and if the issuer is doing a tender? What happens if we do not tender? Is there other things like a cleanup call, or is there any terms that talk about a change of ownership or a change of control for the issuer? So quite a lot of things to look out for.
Okay. Well, that's interesting. So zooming out to the macro view, so how are you looking at navigating the rising interest rate environment right now?
So of course, last year we were coming from a very, very low interest rate environment, and so we had been actually making preparations for that. So we've actually been starting to reduce in duration and keep duration low, and also keeping more cash. And also when we were doing reinvestments, we generally favor more of the shorter dated bonds so that we can have more money returning to our portfolios this year. Also in terms of individual investments, we would need to be more selective. As compared to in a very conducive environment, you are seeing a lot of bond inflows. The market is generally very positive for bonds. In those kind of environment, we generally can't be too selective. The macro flow is that bonds will just generally do well, and so we couldn't afford to be selective. But in other environments, in a negative environments, would have to be a lot more selective.
I see. Okay, since we have launched this CNH new auto-sweep, so we'd like to know, like, for example, when you're managing the CNH, the ELF portfolio, so we would like to understand how do you go about selecting the different bonds? What type of bonds are you selecting for the CNH ELF portfolio?
Of course, we have to balance between having liquidity versus having yield. So in terms of the liquid instruments, we'll of course have to consider bills as well, because they are liquid in some of our unit trusts, existing unit trusts. And also in terms of the CNH denominated bonds, it's very important that we are not just buying bonds of Chinese issuers, but we're also having a diversified pool of issuers from other countries as well. So this helps to reduce the credit risks from China that the portfolio is bearing.
Okay. So how does LGI manage the liquidity for the CNH ELF portfolio?
Yeah, so as I mentioned earlier on, so it's pretty much the same as how we do carry out the liquidity strategies for other currencies as well. I would say the extra parts for the CNH is that we can also have the possibility to go towards the onshore market, and it's certainly a big market, and as an institution we are able to get access. So this would be something that individual investors will not be able to get access to. So if in future when the fund grows very big, this will be an added access as well. But before that, we are managing the liquidity from all fronts as well. So we're also tapping into all the various markets to see what's interesting and what's attractive, and of course then we'll hedge back to the CNH.
Okay. Yeah, well, thanks, Jessica, for the insightful sharing. So I'm sure the viewers
and I would just add also that in terms of the CNH market, there's always ups and downs. So there are always times when there's liquidity squeeze, as we can see from some of the earlier episodes. And for example, during across Chinese New Year period or across the quarter or month end, we may tend to see some squeeze in liquidity, and normally that's the time when we see bond opportunities being available.
Okay. Yeah. Thanks, Jessica, for sharing. I'm sure that the viewers have learned a lot on how to manage the funds and stuff. So we are now opening the floor for Q&A. So feel free to make use of the Zoom Q&A function to let us know some of the questions that you have. Yeah, do feel free to make use of that the Q&A function in Zoom to ask us any questions that you have, so we can take them. Yeah. Looks like there are not much questions. Just hold it for one more. Yeah. Okay, I see one coming in. So should we buy bonds now or wait for the Fed to increase the rates further? Yeah, I think that's quite a good question, because understanding that the Fed is still in the midst of the rate hike cycle. So Jessica, do you have any views on this? Jessica, do you have any views on this? Should we buy bonds now or should we wait for the Fed to increase the interest rate further?
So if it's the CNH market, then it may not really correlate very closely to the dollar markets or the Sing dollar markets. Yeah. So for the CNH market, it follows more the onshore monetary policy and the onshore cycle. I mean China onshore rather than the Federal Reserve. Yeah. So this would mean that for the CNH market, China has its own monetary policy cycle versus the Fed. So for this fund, the fund, the bonds may not really be following US interest rates that closely.
Yes. Yeah. Okay. I see another question. CNH switched by Mervyn Ho. I'm not sorry, I didn't quite get your question. So Mervyn Ho, maybe you can rephrase that question again. Need to deposit. Okay, we have another question on what do you think of the high yield bonds? So especially Asian high yield and China high yield, had they dropped to low enough level? Yeah, so basically we for us, IFAS, we have recently posted our views on the Asian high yield and also China high yield. So you do feel free to have a look at our article. So maybe Jessica, you want to share something about it regarding the China high yield and Asian high yield? Do you have any views on that?
Right. So if it is high net worth investor looking into high yields, into buying specific high yield bond, then it really becomes very, very selective. So of course there are opportunities to be made from that sense if an investor were to be able to do its own credit analysis. So you can buy a bond at very, very deep discount and get back par when the bond matures, and at the same time, because you're buying, for example, the bond at 50 cents, if the bond is paying you 8% coupon, it's actually effectively 16% coupon. So that becomes very attractive. And then plus a capital appreciation when you get back the money at par. But of course, there's that default risk there. So it depends very much on individual names analysis. Whereas if we're looking at a high yield fund or Asian high yield bond fund, then I would caution to look into the constituents rather than just looking at how the benchmark has performed. Because in this market, sometimes the yield look very high because a lot of bonds have traded to distress level, and the next month they may drop out of the index. So you are looking to buy ETF, for example. So this month, for example, if you the ETF has a certain bond that is being marked at 20 cents, next month it may have gotten out of the index. For example, if it has gone into an extension or exchange or default, yeah. So then the ETF may not be able to enjoy that bond exposure. It may sell out.
Okay.
Yeah, and of course, I think in the current environment, we would also need to be looking at IG versus high yield. So previously, if yields are at 2% level, and high yield bonds are offering 5%, for example, that looks like very attractive difference from high yield bonds. But if investment grade bonds are offering 4 to 5% return, then we probably need to look at what's the extra yield from a high yield bond that's on offer there, and how it can how much more it can offer versus the investment grade bonds, because we are now going into a cycle where if we're going to get into a recession, then I think we may start to see a decompression of spreads, whereby the higher rated bonds, investment grade bonds, will perform better than the high yield bonds.
Okay. So yeah, I see another question regarding should we buy SG bonds now? SGD, I think he meant SGD bonds, or wait for the Fed to increase the rates further. So actually within the SGD space, there are so a few good names, but just that for now, because of the rising interest rate environment, we prefer those shorter duration bonds. Those are not like maybe like less than 5 years to maturity or first call, so that they will not be affected so much. Yeah. And also, I think as Jessica shared before, for the SGD bonds, right, they are sometimes the liquidity could be quite bad. I mean, not as good as the US dollar bonds and stuff. So, but they still you can still find good names once in a while. I think there are also new issues from time to time. So yeah, so do subscribe to our new issue SMS and also email, so we do notify you of any like new issue bonds. Yeah. So yeah. Okay. Another question regarding the ignoring concentration risk. would it be better to buy a bond fund or individual bond if you were to get a guaranteed coupon rate? Okay, I think that's a very interesting question. I mean, for bond funds, right, typically funds, right, they don't really guarantee the yield or the interest rate or stuff like that. So for the individual bond, it's easier to get a guarantee, but the guarantee is as good as the issuer itself. Yeah, I'll say. Yeah. So maybe Jessica, you have any view on that?
So in terms of a bond fund, I think probably the investor can also be looking at what's the duration of that bond fund. So if the view is that interest rate will come down, then selecting a bond fund with a higher duration may be a good investment. Whereas if the investor were to be buying an individual bond, then that bond, the consideration should be that that if it's a credit bond, then it should be held to maturity. If the investor wants to trade out, it's likely going to be difficult because as an individual investor to be trading bonds, there's probably a lot of transaction costs, bid-ask spread as well. Yeah. Whereas buying a bond fund may offer more ease for the investor to get in and out. So it depends on the investment horizon. And of course, the quantum of investment as well, the amount, the size of investment, the amount. So in individual bond, for example, the ticket size is rather huge.
Okay.
So the investor has to be very comfortable with the credit risk of that issuer.
Okay. Yeah, so another question regarding, are perpetual bonds risky? What are the differences versus a fixed term bond? So perpetual bond, the risk you're taking is that the issuer may not call back on the first call date. Yeah, this is the thing that you have to be aware of. And also perpetual bonds tend to be of a lower rank than a fixed term bond. So you must look at the subordination. I mean the rank of the bond or so, things like that. Yeah. So yes, whereas a fixed term, yeah.
Yeah, of course, the perpetual bond investor has sold an option to the issuer. So if the issuer doesn't redeem the bond on the call date, it doesn't get into a default. And of course, the investor would have to also look into terms and conditions. Are there a series of call dates? What happens if it's not called? Is the coupon being stepped up or the spread being stepped up, or is there a reset and things like that? Yeah. So for individual investors, it's probably a bit troublesome to study the bond documents before they make a decision on individual perpetual bonds.
Okay, so another question is it easy to buy SG bonds in the open market, or is it very difficult due to lack of supply? I think it depends. Some bonds, they do have good liquidity, I mean when there are a lot of active trading and selling, but some they don't have a lot. So it really depends on the kind of the bond you're looking at. Yeah, I would say. So bond issuers balloted on a first come first served basis. Okay, so the bond issues, the new bond issues are actually balloted. So yeah, so of course, I mean sometimes we do on a first come first served basis at sometimes, yeah. So another question is what is a reasonable return expectation of bonds right now? 4%. So this one is subjective. It depends on the type of bonds that you're looking at. If you're looking at the high yield bonds, of course, definitely there'll be more than 4%. But if you look at a typical, maybe the investment grade, where I'll say 4-5%, yeah, I think that's not that hard to get also. Yeah. So what do you think, Jessica?
So if you were to buy, I mean, right now, it's bonds that are yielding 4 to 5% for a few years, mid-tenor, of course, are available. So if the horizon, investment horizon is to hold to maturity, and the investor doesn't need the funds in the meantime, then buying that bond at a certain yield, 4.5, for example, and holding to maturity means that you get to enjoy 4.5% for the investment horizon of the instrument. Then of course, when we look at this yield, it also means that when you receive coupons and things like that, you are able to reinvest at this yield. So this is like the standard the textbook model for deriving yield. And of course, in reality, it may not be possible to reinvest at the same yields as well. So it may end up to be lower as well. Yeah.
Okay. Yeah. Okay. I think we just, for the interest of time, I think we will take the last question. So yeah, if I can hold to maturity, why wouldn't I take a longer term bond duration to lock in the higher coupon rates? Why is everyone recommending short duration bonds? Okay. So yeah, so I would say that yes, definitely. If you can hold to maturity, definitely you can lock in the interest rate, because we know that eventually somehow the interest rate may not stay high forever. I mean, somehow you will just come down. But the thing is, you must have the holding power to hold through, and also you must really make sure that you want to hold to maturity. Let's say you are buying a 20-year bond or 30-year bond. I mean, but the thing is, you won't know what can happen in 20 or 30 years. So you may want to like sell it prematurely before it matures. Then if you sell it prematurely, you may not get back the proceeds. You may incur a loss. So this is something that you have to be aware of, which is why we recommend a short duration bond. Yeah. Yep. So you got anything to add, Jessica?
No, I'm fine.
Okay. Yeah, I think that's good for yeah, okay. So okay, yeah. So now so thank you for the question, the Q&A. So now we'll move on to the next segment. So just okay, so before I close off, some of the marketing messages for our viewers. So on top of the investing and trading on the FSMOne, on top of investing and trading on FSMOne, you can also spend your money on the cash account using the digital FSMOne debit card. So and also the debit card is a collaboration with the major payment institution that's regulated by the MAS, and it's also compatible with Google Pay. So Android users can also add to your mobile phone. And card security, like adjusting the spending limits and locking card, and can also be done in the app. So there's no subscription or annual fees. Yeah. Okay, so yeah, once again, thank you for spending the evening with us, and feel free to reach out to us if you have any questions. Yeah, now I'll pass the time back to Yikai. Yeah, Yikai, please.
But yes, thank you, Darren and Jessica, for the wonderful sharing, and also a big thank you to everyone here who is with us this evening. I hope you find the sharing useful and in your investment journey. So before I end today's webinar, I would like to share with you two things. One is the latest promotion that Fund Supermart is running. So if you can see on the screen, so from now till 31st December, if you invest the money in your SRS account with us, in funds included under the SRS scheme on our platform, we will be rewarding you with cash credits. So as you can see on the screen, the minimum investment amount be rewarded starts from $5,000. So the more you invest, the more cash credit you will get. And the cap is $100. And if you are a new SRS investor, the deal gets even sweeter. We will reward you with double the cash credits, capped at $200. So for those who are more interested in ETFs, so if you choose to invest your SRS funds in ETF instead, we will also reward you, but instead of cash credits, you get to enjoy 2 free treats. So for more information, you can scan the QR code as shown on the screen. Otherwise, feel free to contact us and we'll be happy to assist you. So for the next thing that I'm sharing, we will also be running a webinar next week, same time, Wednesday at 7 p.m. to share with you the options to grow your SRS funds. So our in-house investment advisor and analyst will discuss ideas that you can adopt to create a globally diversified portfolio in the long term. So again, scan the QR code to register today. So with that, the webinar has ended, and have a great evening, everybody. I'll be leaving the screen up for a while. Feel free to scan to register for our next webinar. Otherwise, you are free to leave the room anytime. Thank you once again.